I like dogs. I also like money. And when I was a child, I used to play with bubbles and dogs and would also hope that one day I would have a lot of money. Is there a way to combine all three of those things at once? That would depend on how you interpret the meaning of dog, bubble, and money. But I can assure you the answer to that question is very colorful and interesting. We will look at what some call the first financial bubble in history, how it got started, and what we can learn from it. Full disclosure, I used to own cryptocurrency, but I no longer have any. The information in this presentation is factual and taken from publicly available sources. It is not advice. Any opinions expressed here are for the purpose of sharing a point of view for educational purposes. If anyone should act on any of this information, it is solely their own responsibility. Do your due diligence and research before making any investment of any kind, whatever that investment may be. Please like, share, and subscribe, and click the notification bell to stay up to date. What's the deal with tulips? What are tulips? Tulips are bulbous plants that look like onions but are not. They are native to the Tian Shan mountain range in Central Asia. They have been cultivated in Iran as early as the 10th century, and by the 11th century they had made their way to be grown in Constantinople. It is a gorgeous flower and had grown so popular there that it had become what you would think of when you think of the Ottoman Empire and the Ottomans. By the 17th century, through trade, tulips had made their way to the Netherlands. It started as a popular flower to collect, for which wealthy people were willing to pay large sums of money to add to their collection. As the tulip trade boomed and became very profitable, it became traded like a commodity, and people began to speculate on its price, thinking that it will go up. As speculation soared, there were fewer and fewer buyers who were willing to pay that much, and then without any more willing buyers, everyone tried to sell at the same time and the price collapsed. As the story goes, some traders went from rags to riches to rags, and that those people lost everything. Although that is not entirely true, we still laugh at them for that 400 years later. The truth about what happened is pretty mystifying. Yes, the Dutch still do love their tulips, but they were pretty common and mundane, and after the price stabilized after the crash, the Dutch continued to grow and trade tulips. And they are currently the world's largest producer of tulips, producing 60% of all of the tulips in the entire world. But the tulips from the mania were not the same tulips that we grow today. The tulips that were sought after, for example the Semper Augustus, were thought to be especially rare and beautiful, and they were, but they no longer exist. The natural coloring of a tulip comes from two factors. There is a base color, which is always yellow or white, and then there is a hue, which comes from a type of chemical compound called an anthocyanin that changes color based on the acidity or basicity of the flower. The tulip will show this striping effect when it is infected by a tulip-breaking virus, which suppresses the anthocyanin compounds, leaving a very interesting pattern. Well, the virus that made the Semper Augustus rare to begin with ended up driving it to extinction, and there were none left. It was inherently so scarce that it vanished, taking any value that it had along with it. What is an economic bubble? You may have heard the term bubble in an economic context before, but for those who have not, let's get on the same page. A bubble is an economic phenomenon characterized by a rapid, unexpected, exponential-like increase of an asset price followed by a rapid decline. These price fluctuations are commonly the result of market behavior and perhaps speculation. That price in a bubble is not connected to the intrinsic value of the asset. This could have the result of being from a supply shortage, or it could just be the result of plain old gambling. To really understand the economic bubble, also known as the tulip mania, we need to put it in terms we can understand. When we look at this chart, we can see that tulip prices rose from about 10 guilders a bulb to about 200 guilders a bulb in just 2 months. That's a 20 times increase in price. Some tulips ended up going from 125 guilders a bulb to 1500 guilders a bulb. To put that into context, at the time, a Dutch laborer would earn about 300 guilders per year, and a master carpenter would earn about 450 guilders per year. But what does that mean? Well, a guilder at the time was 605.61 milligrams of gold, so for simplicity's sake, we could look at what it buys by converting the purchasing power into gold and base that off of today's gold prices based on the weight of gold that they were paid back then. If we price that to purchasing power today at $59 per gram, then we would get that a laborer would earn around $10,700 per year, and a supervisor would earn about $16,100 per year. When we see what that stuff used to get us back then, based on what stuff cost, we get that a year's worth of soap would cost 7 guilders, 200 eggs would cost about 4 guilders, and Rembrandt's house in Amsterdam at the time cost 13,000 guilders. If we do the same conversion on different types of tulip that were trading at the time, and if we price it relative to gold, then we could see that the average tulip would cost around $7,000 per bulb, and that a Semper Augustus could cost over $350,000 per bulb. $350,000 for a tulip. A tulip, a flower that does not actually feed you. That is a very stark disconnect from its intrinsic value. This disconnect is precisely why the price came crashing down nearly as fast as the price went up. This was the first major financial bubble in history, and it would not be the last. What can we learn from it? If the price of an asset goes up much faster than normal, that could be a good indication of a bubble. Historically, one way to tell if an asset is priced reasonably is by looking at the historical price relative to itself. We will use the Nasdaq Composite Index from the late 1990s as an example, because this is what was referred to as the tech bubble or the dot-com bubble, and it consisted of a bunch of overvalued technology stocks being bought up and then sold off rapidly at the time. In very general terms, the prices of assets tend to increase in price over time. Prices do fluctuate in a range of values, but over that time it will reach a maximum in its range of prices and a minimum in its range of prices. We can draw a line to see what level that is, and we would call that a trend line. The maximum range of prices over the time period would coincide with the upper trend line. We can also draw a line along the lower range of prices for an asset, and that this would be the lower trend line. In many cases, if a price falls below its lower trend line, that asset might be thought of as undervalued, and investors may view that as a good opportunity to buy. If an asset goes above the trend line, then that asset might be thought of as overvalued, and those holding it might think it's a good opportunity to sell. If something breaks above the trend line rapidly at a much higher rate than normal, then it is the result of having a fast increase in the number of buyers. However, when this happens at a rate of 2 or 3 times of what the buyers were and what the increase was normally, it is frequently the case that the market runs out of buyers and that it only has sellers, and that the price of the asset will rapidly trend downward nearly as fast as it trended up. Sometimes after the bubble peaks, there are investors who want to buy the dip. If investors or enough players want to buy in, they can temporarily reverse the downward cycle, ultimately to crash back down to reality and back below the trend line. This is commonly referred to as a bull trap because those who are bullish or optimistic on its price valuation tend to buy back in, not realizing that the bubble has burst and that ultimately they are losing money in the process. There are many historical examples of bubbles where there might be a crack up boom followed by a crash bust. The Dow 30 in the 1920s saw a long-term upward trend and a healthy fluctuation of prices, followed by a break from trend and then a hard crash in 1929. There was even a bull trap at the end of 1929 before it crashed down further. Other famous examples of bubbles include the Japanese stock market of the late 1980s that had some kind of crack-up boom, bust, bull trap, and continued crash. One famous example from recent history was the housing bubble of the United States. Housing prices boomed throughout the early 2000s and then crashed at the end of 2007. We saw a similar thing happen in December of 2017, with Bitcoin rising to around $19,600 in its intraday peak price, only to come crashing back down to a low in December of 2018 of around $3,200 in a period known in the crypto community as the crypto winter. There was recently a famous bubble in the stock of a company called GameStop. Its price rose 10 times in 5 months from $4.33 on August 10, 2020 to $43.03 on January 21, 2021. When it rose over 10 more times in 5 trading days from $43.03 on January 21, 2021 to $468.49 on January 28, 2021, ultimately to come crashing back down another 5 trading days later to $53.38 on February 4th, 2021. You can tell me that there were reasons the stock was valuable or that there were competing conspiracies of players, but one thing is for certain, and that is that this was a bubble. The meteoric rise in price is not justified by any reasonable measure of value or expected growth in the company, and this was entirely speculative, and it fit the pattern very well. So what does this have to do with dogs? I just think dogs are great. They have enormous intrinsic value because they're so lovable. I would hate to see people speculate on them as currency or as a currency named after them, such as Doggycoin. I think it's pronounced Dogecoin, but it's literally spelled Doggycoin. Dog-e-coin. I like to call it that because it reminds me of dogs, and I love dogs. The point is, there are a lot of things nowadays that are starting to look like a bubble, and it's only a matter of time before they run out of buyers and the bubbles burst. I have pretty mixed feelings about cryptocurrency or digital money, and I can make a pretty compelling case either for it or against it. If you're interested in investing in some cryptocurrency, you may be able to make some money, and we should let the money do the talking. But don't forget that trends do come and go, and that this year's crypto treasure can become the next year's crypto trash, just like with Dash. And what started as a joke, in the end, can make a joke out of those who bought it. To avoid getting sucked into a bubble, we should never forget the difference between price and value. But nowadays, people seem to know the price of everything, but the value of nothing. I hope this was informative. Please be sure to check back in the future for more videos like this. Thank you for watching.